So if you're a director, your pension could be one of the most tax efficient ways of taking money out of your business. And we're coming up to the end of the tax year, but it's not just about the personal tax year, it's about the company's tax year as well. And you need to think about, are you making the most of all of your allowances? So in this video, I'm going to break it down, what you need to know about pension contributions, how you can reduce your corporation tax bill, and also to make sure those past allowances are being used before they disappear. And especially we're going to have a look at what the HMRC rules are on all of this to make sure you're on the right lines as well. So let's get into it. The first point I want to look at with you today is why pensions are great for directors. Look, unlike employees who rely on salary-based contributions, directors can make contributions directly from their company, and that comes with better tax advantages fundamentally. You know, putting into a pension's great. There's no national insurances, there's no personal income tax, and that's brilliant. But actually, if the employer makes the contribution, your company, and that's really important, that if you set up a pension, that you go off and do it yourself, that knows that you're making what's called employer contributions. But the great thing is, it's going to reduce your corporation tax bill, isn't it? Now, the funny rules with corporation tax now is that when we start making more than £50,000, up to £250,000, we're going to pay an effective tax rate of 26.5%. So actually, if you're in that zone, actually making a pension contribution can be really, really tax beneficial, because we're going to save that 26.5%. I recorded another video all about how this funny marginal relief works with corporation tax, and I'll throw the link up on this video so you can click on that and maybe have a look if you're not fully clued up on how that works. The second thing is, how much can we actually contribute? Well, the standard pension allowance is £60,000 per annum, and company contributions aren't restricted by your salary. There's something called relevant earnings, and a lot of directors are paid a very modest salary, and then they take the rest through dividends. Unfortunately, dividends don't count towards kind of relevant earnings, so you can only put 100% of your relevant earnings. But if you make a contribution from your company as the employer, you're no longer restricted, which is why you want to be able to do it that way. But 60,000 is the most that you can put in. Now, one of the things that HMRC says about this is that the pension contribution should be wholly and exclusively, and that's normally we see that to do with business expenses, but is it wholly and exclusively for the benefit of the business? Well, in my view, is that making a kind of up to £60,000, and if you're doing that on a regular basis as a company, there's lots of company directors out there taking, on payroll schemes, taking large sums of remuneration, including pension, up to that threshold. So absolutely we can justify that. But if we start using up unused allowances, and from prior years, and say we made £100,000 contribution, but we were taking very little out of the business anyway, HMRC might raise that as a flag and say, was that really wholly and exclusively? So try and just think about staying in the commercial reality. I think for most directors, it's easy to stay within commercial reality. There's lots of examples elsewhere of directors getting paid really serious money. And if you've got, obviously, it takes a lot of time, effort, risk to actually run that business. So you should be being rewarded correctly. But look, if you're in doubt, speak to an accountant. My colleagues at Orange Umbrella would be happy to help you as well. But, go and get some help and support, because we want to make sure we're staying within the realms of the rules. So number 3 is you're carrying forward potentially unused allowances, and it's a good idea to check in and see where you're at. So if you're in a great position where you've already used your £60,000 allowance and you're thinking, actually I didn't do very much in the previous year, don't worry, you can actually use those allowances from the past 3 years. And what you need to think about is, you've got a current year allowance of 60,000. You must use fully used, and then we can go and have a look at the previous 3 tax years. If you hadn't contributed anything to a pension, in theory, you could contribute up to £180,000, which is a hell of a lot of money. But don't, I'm recording this right at the end near the end of March of 2025. The allowances for 21-22 are about to kind of expire. So if you're watching this shortly after I recorded it, go and have a look at it. You might be watching this sometime after I've recorded it, but the same principle applies. Go and check in, see how much you contributed in those tax years, and make sure you're making the kind of any unused allowances. Obviously, you're probably a higher earner if you're in that position where you can do that, but obviously maximising pension contributions is a great choice to make rather than necessarily taking income, and you're planning for the future. These are all great things to consider for the future as well. Number 4, when should you actually make these pension contributions? That's a really important thing here. There are 2 key deadlines for you to keep in mind, and the first one is the company financial year. It's likely that the company financial year might be different to the personal tax year. So if you're wanting to reduce your corporation tax, you must make contributions before the end of the company's tax year. My company tax year is in October. So obviously, if I want to reduce corporation tax, I should be making those contributions before the end of October, or making to choose a lump sum contribution at that point. We should all be able to go and run a profit and loss for our business to see how we're doing on a monthly basis. So we should have a general feel about the profit before we get to the end of the tax year. And if you can't do that, then maybe something isn't quite right in your business, and you maybe need to revisit some of your bookkeeping controls and all of that sort of stuff. But it is important not to forget about that date. There are things that you can do, but they're not easy to do, and we tend to not advise clients to do them if they miss the deadlines. And I have had clients who just forget, even though I've told them about it. Put it in your diary at least a month before the company year end, saying check the pension situation, check my corporation tax situation, so I know what I'm doing. The second part of it is about the kind of the next deadline is the personal tax year. Personal tax year ends on the 5th of April. This is important for directors on PAYE. Maybe you're not in a family-owned business like I am, and you've got maybe 5 other directors, and you've chosen to just be on commercial salaries to reflect the jobs that you're doing. There's a couple of kind of good things that you can think about here. Is obviously pension's really important, that you could choose to make an additional contribution towards your private pension to lower you down. This is really useful if you're in a kind of a tax threshold between 60 and 80,000 where you might be losing child benefit. Those pension contributions are going to let you keep some more of that child benefit. That could be a huge tax saving, actually quite remarkable, getting on for like 60%. If you are in the 100 to 125,000 pound bracket, you're losing your personal allowance, and again, making additional pension contributions to lower you back down has a huge impact on your tax situation as well. There are a couple of other things to think about as well, is understanding exactly what's going on. Don't forget, it's your responsibility to reclaim the tax relief on your self-assessment or by writing a letter to HMRC. There are millions of pounds goes unclaimed every year. People just don't reclaim that tax relief when they're a 40% taxpayer. Again, understanding how your payroll works if you're in that situation. Is it a relief at source pension or a net pay arrangement? If it's relief at source, like People's Pension or Nest, then you might, depending on how the scheme is set up again, you might need to go and just actually revisit and have a look at how that kind of is that 20% tax relief, and understanding what's going on. To be brutally honest, I have kind of meetings all the time with kind of people who are higher paid and look at the kind of their pension situation and find that they haven't been claiming that 20% tax relief. Finally, before I move off that point, is if your company, in that situation, you've got, say, a few directors getting more kind of a more commercial rate. Talk to your co-directors about whether employer contributions from the company, whether you could create a better scheme, or moving on to a salary sacrifice model might be a better way to actually run that. Point 5 is about pension tapering. If you're a higher earner and that your salary is getting up to £260,000, your pension limit is going to come down from 60,000. So it's going to reduce by £1 for every £2 that you earn over 260,000, and it can drop all the way to £10,000 if your income's going to hit 360,000 or more. My advice to clients is, as soon as you hit £200,000 of earnings, go and speak to an accountant. You should be putting in a self-assessment tax return anyway. Go and talk to someone who knows what they're actually doing. Check in with your financial advisor, so someone is actually calculating that threshold. Things like salary sacrifice contributions do factor into that calculation as well. So you do need to be really, really, really careful with what you're doing. Number 6 is about regular contributions. These can be a really smart move. I've got lots of clients who like to look at their corporation tax situation and make a lump sum towards the end of the year. The problem is with that is about pound cost averaging. Is the market is going up and down all of the time, and you can be really unlucky at that. For a few years you could choose to put money in when the market's really at a high point, and then it's coming down. So you can look at your pension and be a bit like, oh, it's not doing very well, has it? Actually, because the stock market is moving up and down all of the time, it's a good idea just to put regular contributions in. We should be able to run those profit and loss accounts, so we should have an idea of monthly profit. So set a monthly direct debit up to your pension provider or with the firm of financial advisors that you're working with, where it's coming out on a regular basis. And then when you look towards the end of the year thinking, should I make a bit more? Actually, the lump sum is lower and you're less likely to be affected by those kind of price fluctuations with things that are happening in the marketplace. My final thoughts on this. Okay, let's just wrap things up. Ultimately, pension contributions are one of the best tax saving tools for company directors. If you're like me, running a small business, it's a great way of reducing your corporation tax bill. It's helping you grow your retirement pot, and it's ultimately a way of extracting profits really tax efficiently. The things that you've got to do after watching this video, what are those? I want you to go off and find out when your company year end is, because that's how we're going to be able to reduce that corporation tax. I want you to go off and have a look at those unused allowances before they expire on the 5th of April. Be mindful of pension tapering if you're in a fortunate position where you're earning over £260,000, and think about regular contributions as well. It's important that you take action on pensions. Speak to your accountant, your financial advisor. Make sure these things are structured correctly. If you found that video useful, then please think about liking the video and subscribing to the channel. And I can't wait to share the next video with you. All right, thanks. Bye.